Welcome to this BDO webinar. In this webinar we will cover the new side-by-side package that was released by the OECD earlier this year on January 5th. And as we have limited time, we will try to cover all these topics in just 30 minutes, and then you can leave and go on with your rest of your job. My name is Steven Bronner. I'm an international tax partner based in the Netherlands. And for this webinar, I will be joined by Frederick Boulogne here in the studio, and online by Ross Robertson in the UK, Dustin Stamper in the US, and Christina Busch from Germany. But before we go into a bit more of the detail of this side-by-side package, I want to give a short recap on why we are here. Basically, the model rules that were designed by the OECD have grown in complexity, and there was a large need for further reduction and further simplicity, and that is clearly part of this package. And a second element is the June G7 agreement to facilitate the concerns from the US and to make sure that with the side-by-side agreement, the US would still participate in the Pillar 2 and GLOBE implementation. Part of this package is also that there was a need for a broader scope of incentives, so that's also part of this package. And we can basically say that with the publication of this package and with the further implementation in countries, the Pillar 2 package is now finalized and secured, and is now really up to adoption and implementation by all these countries. And as you may know, already 55 countries have adopted the Pillar 2 legislation in some type of form already. What does the package include? So the package basically has four main topics. Most of the content of the package is covering the new simplified ETR safe harbor. This is a permanent safe harbor that will apply from 2027 and in some countries already 2026. And that will basically replace the transitional CBCR safe harbor that is now very often used by many M&Es. In order to avoid any gap between the transitional safe harbor and the new permanent safe harbor, the transitional safe harbor, CBCR safe harbor, will be extended for another year. And as a third element to the package, there will be a new substance-based tax incentive safe harbor that broadens the scope of incentives without any risk of being topped up by a DMTT or IR. And as a last element, and basically the main element of this package, and also why it carries this name, is the introduction of a side-by-side system that will give 2 additional safe harbors for countries with an eligible tax regime. Now I want to hand over to Frederick to give more insights about the simplified ETR safe harbor.
Yeah, thank you, Steven. So at 57 pages in the side-by-side package, the simplified ETR safe harbor is not exactly simple, but it's a critical part of the package. If you were to summarize it in a punchline, it would be the ability to rely on consolidated financial statement data, to do that on a jurisdictional basis and with far less adjustments and elections than we would see under the full GLOBE. So essentially, a simpler way of calculating whether top-up tax is due for a jurisdiction than the full GLOBE, essentially also a successor of the current CBCR safe harbors. Looking at how this simplified ETR safe harbor works and the eligibility criteria, again, it is tested on a jurisdictional basis, but not all entities qualify for this simplified ETR safe harbor. There's some rationale in this. So the main ones not qualifying would be investment entities and stateless entities, none of which are subject to tax themselves. So they would not be entitled to this safe harbor, but potentially their owners or their investors may still benefit from these rules. If we look at the way it's an ETR again, so a fraction of income or taxes divided by income must be correct. Starting with the simplified income, the basis is the financial accounting net income that we will find in the consolidated financial statement data, plus the jurisdictional income tax expense. But very clearly the rules state that we disregard the deferred tax expense that sits as a topside entry in the CFS. Then we need to make a couple of adjustments, and they're potentially a couple of elections that can be made. The basic ones are quite straightforward. They would be the main book-to-tax differences that we see in most tax systems worldwide. So dividends and capital gains would be eliminated from the income. That's a very standard, I think a very standard adjustment. There are a couple of industry-specific adjustments. They relate to the financial services industry, Tier 1 capital for banks, certain provisions for insurers, and there are some adjustments for shipping, for the shipping industry. There's also a conditional adjustment that groups can rely on, and that's particularly interest for those groups which have significant M&A activity. And then there are a few optional adjustments, and essentially what you can still do as a group, you can elect for each of the globe adjustments that we see in the full globe rules, and groups would therefore have to make an assessment whether it's favorable to make any of those elections and rely on those adjustments. Moving to simplified taxes, the starting point again is the jurisdictional income tax expense, plus the deferred tax expense we take as a topside entry, and then again a number of adjustments must be made. There are a couple of very basic ones, that the taxes must actually relate to the simplified income, and that we're only looking at taxes that are actually covered for Pillar 2 purposes. There are also a number of adjustments we believe are very important and make the calculations way simpler relating to deferred taxes. One of them is that there is a tricky recapture rule in the globe rules, which requires you to track DTL movements over the period of time. But for the simplified ETR safe harbor, you don't need to apply that rule. And similarly, there's a easier way of recasting deferred taxes to basically globe taxes for this calculation, which you can do for your entire deferred tax expense. So a simpler way of recasting. And then there is a couple of optional adjustments that group can rely on, basically to select more covered taxes, simplified taxes for this calculation. So you would have a higher amount of simplified taxes. And those elections are very much linked to the case where you also have the election for the income, the underlying income element. There are a number of special elections in the rules as well. An important one would be post-year, relating to post-year adjustments. Essentially, if there are certain tax true-ups within a period of 12 months after the financial year, you're able to take them into account upon election in the prior year, which would give a better reflection of ETR in that year. And of course, the idea is potentially a higher or sufficient ETR in the prior year. Then there's a few simplifications, one relating to cross-border allocation of taxes and income concerning permanent establishments mostly. There are some very detailed rules on this topic in the globe rules, and there's a simpler way of allocating tax and income to permanent establishment you can elect for. And in addition, in the area of transfer pricing, where certain transfer pricing rules in the context of globe, there's a simpler way of applying transfer pricing both within the jurisdiction and in relation to cross-border transactions. But the rules are very, very detailed. And lastly, there is a number of additional simplifications groups could consider. Looking at the eligibility criteria, a main one would be that there is no top-up tax due for that jurisdiction in either of the prior 2 years before the application of the simplified ETR rules. So you need to go 2 years back, assess whether top-up tax was due, and then you would be eligible for simplified ETR. And this is coupled, this entry criteria is also coupled with certain re-entry criteria if once you've gone out, but you want to get back in those rules. In principle, the rules would apply as of 2027, but there is very clearly the option that countries already implement the rules in 2026. Having said all this, Christina, we still have a CBCR safe harbor in place up to 2026, and now with the extension also for year 2027. Can you give us an overview how this CBCR safe harbor compares to the simplified ETR safe harbor?
Yeah, thanks, Frederick, for introducing the new simplified effective tax rate safe harbor. And also hello to everybody listening to us today, to our Pillar 2 webinar. So if we look at the differences, the major differences between the existing transitional country-by-country safe harbor and the permanent new simplified effective tax rate safe harbor, then at first glance, of course, we have to see and to look at the tax rate. So whereas the current country-by-country safe harbor applies a 17% tax rate for the effective tax rate test, at least for the year 2026 and 2027, we will go for 15% with the new safe harbor, and that corresponds to the existing full globe minimum tax rate. So good news for taxpayers that we do get a simplification and still apply the 15%. Frederick already mentioned the applicable dates. So the new safe harbor generally shall start in 2027, perhaps in some countries, depending on the actual implementation, already in 2026, whereas the country-by-country safe harbor, so the transitional one, will end in 2027, at least for companies having a business year corresponding to the calendar year. So we do see that the transitional safe harbor will come to an end, whereas we know that there will be a new permanent safe harbor coming up, which I think is good news for taxpayers. More important, I think, is the new one of re-entry possibility for the new safe harbor. So many of you know that the transitional ones apply a once out, always out approach, meaning that if you do not fulfill one of the tests for a jurisdiction, you cannot apply the country-by-country safe harbor for that jurisdiction in future years. That will be changed with regard to the new safe harbor. So taxpayers will be allowed on a jurisdictional level to re-enter the simplified new safe harbor. However, depending on the requirement that no top-up tax was triggered for that jurisdiction for the last 2 years. So I think the basic idea of the OECD here is that to make it easier to switch between the simplified calculation and the full globe calculation. And we can see that also if we look at the data requirements. Another difference I like to mention here is the transition year. The transition year is delayed for the safe harbor periods applying the country-by-country safe harbors, whereas the transition year shall be triggered by electing the new simplified ETR safe harbor. So for M&E groups for which the transition year had not already been triggered, the first year in which the group elects the simplified ETR safe harbor, that will be the transition year according to full globe. So more important, I think, are the differences with regard to data requirements and data adjustments. Whereas currently, with regard to the transitional safe harbors, we more or less rely on country-by-country reporting data with only a few other data points. So, for example, importantly, of course, taxes. We now look at group financial statement data, meaning that we can use reporting packages for the simplified ETR safe harbor. What we do see in addition is that for some countries applying a local financial data requirement for QDMTT, that shall also then be applicable for the simplified ETR. However, the OECD hopes that countries do also allow to use group financial statement data. We will need to see what happens with regard to the implementation on the level of the jurisdictions. The most important thing and differences, I think, relate to the data adjustments. The country-by-country safe harbor, of course, has only very limited adjustments possible. Typically, no adjustments possible for standard book to tax differences. And that makes it for some M&E groups difficult to apply the country-by-country safe harbor in specific circumstances. That will be changed with the new safe harbor. So there are, as Frederick already mentioned, specific basic mandatory adjustments. For example, we now cover equity gains and losses. We also will still have the recast of deferred taxes to 15%. however, in a much simpler way compared to the full globe rules. And in addition, we do see a lot of options for taxpayers to apply additional globe adjustments. So that, however, comes with a price tag, because that, of course, increases complexity compared to the transitional ones. So we do have, on an advantage level, we do see a lot of advantages coming up with the simplified ETR. In particular, it's a permanent one, no more once as always out. We do get to more adjustments, which shall enable taxpayers to have a more robust and reliable system. On the other hand, it clearly adds on more complexity and requires more calculation and modeling in order to see if it is beneficial or not to apply for the simplified ETR. And talking about this, I would like to hand over to Ross so that he can talk a bit about what does that mean with regard to the mechanism and the calculation of the new rules.
Thank you, Christina. So I think there's probably three broad points that I'd make here. So the first point is to note that these announcements apply to accounting periods beginning on or after 1st of January 2026 or 2027, depending on the matter we're talking about and the legislative approach that countries take. There is no deferral of existing compliance deadlines. Therefore, compliance for the first 2 years of the Globe rules is unaffected, and groups should continue planning on that basis. So that means that it will be the transitional country-by-country reporting safe harbor that is the primary safe harbor most groups will be considering for the first 2 years of compliance, alongside the UTPR safe harbor for groups headquartered in jurisdictions that have not yet implemented Pillar 2, but noting that the UTPR safe harbor only applies for the purposes of the ultimate parent entity jurisdiction. So the second point is, I think, looking forward, the intent of these announcements is to secure the long-term future of Pillar 2. The rules will no doubt continue to evolve, and there are further attempts at simplification noted in the package. But if you were hoping that Pillar 2 would disappear, that is currently not the path we are on. This means that you should really now be planning into the long term to the extent that you've not already done so, thinking about what compliance looks like and the role technology plays in that over time as we transition from one version of the rules into another. And this really means looking beyond the transitional period. So although the transitional country-by-country safe harbor has been extended for 1 year, it remains temporary. And the permanent simplified ETR safe harbor operates on a fundamentally different data set with a fundamentally different set of principles. So you may need to think about how you approach that differently. Some groups have only needed to consider the transitional CBCR safe harbor to date and have not had to dive into the full detail of the Globe rules. I think that will now be necessary, at least to a certain extent, to ensure that the group is able to comply with the requirements of the new safe harbor. Because the new simplified ETR safe harbor is essentially a subset of the full Globe rules. Yes, there are a limited number of mandatory adjustments aligned with those in the full Globe rules, but there are many optional adjustments and elections. And to really grasp how to apply the safe harbor, you will need to have a good grounding in Pillar 2's principles themselves, such as how income and tax allocation works, how deferred tax works under Pillar 2, how transfer pricing is approached, and how book tax differences are addressed more generally. I think the final point that I would make connected to the above is that while there is perhaps a view that you do not need technology or external support if you are wholly reliant on the transitional CBCR safe harbor, given the potential simplicity of that, you may wish to revisit that once the transitional CBCR safe harbor is no longer available. So the new permanent simplified ETR safe harbor is indeed simpler than the Globe rules, but as Frederick noted, it is certainly not simple. There are over 50 pages of rules and guidance already released with a promise of more to come. I think also, while we don't yet know what GIR reporting will look like where the simplified ETR safe harbor applies, the determination of the application of the safe harbor requires an aggregation of data points and adjustments to those data points, which for larger groups will be much easier to manage with a technology solution in place. And I think it's important to note here that this is fundamentally different to the transitional CBCR safe harbor application, as a number of the required data points for the transitional CBCR safe harbor are already being collated granted under the CBCR process, but the application of the simplified ETR safe harbor will require design and implementation of new processes as a minimum to aggregate that data and then to analyze for adjustments. So with that, I'll hand back to you, Frederick.
Great, thanks, thanks, Ross. And having discussed those safe harbors and putting them in a time overview, it's very clear that groups must assess which safe harbors apply to the groups on a year-by-year basis, which rules still continue to apply. So one point to make here, even if a certain safe harbor may apply, for instance, at UPE level, there may still be a tax applied to subsidiaries in that group which are not captured by that safe harbor. So having a very good understanding of each of the safe harbors, its exact scope and the application to your group on a year-by-year basis will be critical. We've shown how the rules going forward will eventually move towards a full set of rules applying for all the years as of 2028, and a large number of safe harbors potentially applying. Having said this, we've seen the release of the side-by-side package last week. But what would be interesting to understand, and I'll switch to Christina here, is this package, which was published by the OECD, has to become law in the jurisdictions where Pillar 2 is applied. And can you make a very short comment, Christina, on the application of this side-by-side package and the rules in a country like Germany, which is part of the European Union?
Yeah, Frederick, indeed, that's a very good question and an interesting question. How do we implement that? So from a European perspective, clearly we have to consider that there's the European directive implementing minimum tax. However, the EU Commission already announced that there's no need, luckily, to amend the directive again, because all these new safe harbor, intentionally, of course, named as a safe harbor, fall within the scope of Article 32. However, on a jurisdictional level, that clearly demands amendment of existing law, and we will need to see how fast governments react. In Germany, I would expect that we at least start with the process in 2026. And from a taxpayer's point of view, to the extent we consider these rules are in favor of the taxpayer, I'm quite confident that we can apply these rules retroactively, which is also the idea of the OECD. But we will still need to see how long it will take and need to monitor the details of the individual amendments. Saying that, Ross, it would be interesting to look at the UK. What is intended there?
Yes, so very similar. As for the EU, we will require legislation to put these new amendments into UK law. However, HMRC has already stated that those amendments will be applicable from the 1st of January 2026. Whether that gets legislated as accounting periods beginning on or after the 31st of December 2025, or if it truly is 1st of January 2026, is a point of detail that is probably not that relevant to many, but we'll need to wait and see. There's also reference to further simplifications within the SBS package. Generally, the approach that HMRC has taken to date is that where there is an amendment to the rules which is favourable to the taxpayers, there has typically been the ability to make a retrospection election to apply that simplification or concession from an earlier date than which it's legislated for. I think important to note for financial reporting purposes that we'll probably be in a position where we'll have an expectation of the application of law before that law is actually substantively enacted. So that's just another thing to consider.
Great, thank you, Ross.
Yeah, thank you, Ross, thank you, Christina. Now on to the next topic is the substance-based tax incentive, which is part of the package as well. And this is a new safe harbor, and that broadens the scope of tax incentives that will not be facing a top-up tax. The current rules already have a facility in place, the QRTCs, that already avoid the tax incentives to be adjusted via the top-up tax. But these QRTCs are found to be quite restrictive because they are dependent on very strict rules and need to be refundable within 4 years. The new substance-based tax incentive, the QTI, is really focused at a two type of incentive, which are either expenditure-based or production-based, and they will, unlike the QRTCs, they will reduce, or basically the reduction of the covered tax due to tax incentive will be replaced and will be basically nullified, and therefore your covered tax will increase, and therefore effectively your effective ETR will decrease, or your ETR will increase and your top-up tax will decrease. There is a cap to this new incentive, which is to make sure that these incentives are linked to genuine activities in the jurisdiction. So therefore there's a cap of 5.5% of the payroll cost, and upon election 1% of the tangible assets. So as said, it's are basically two types of incentives: expenditure-based. There you can think about super deductions, additional credits on green investments, or production-based incentives, and there you can think about carbon type of credits that give a income tax reduction. So the rules clearly say it does not need to be a deduction on expenses, but it needs to be a incentive linked to an investment, to an expenditure. But it can also be a reduction of your income. With this new incentive in place, we basically have three elements that facilitate companies with and basically avoid tax incentives to be topped up. The first one is the SBIE, the Substance-Based Income Exclusion Rule. That's basically a general reduction of the globe income depending on payroll or assets. The second one is the QRTCs that is already currently in place, but is quite limited because of the criteria of it being refundable within 4 years. And then the new one, the QTI, is targeted at expenditure-based incentives. And this whole package will hopefully facilitate many companies that the incentives they have in place will not be adjusted via the top-up tax. Likely, what will this mean for companies? This new incentive will mean that you will need to reassess your current incentives already in place, whether they qualify under this new safe harbor. So this may mean recasting your ETR calculations. And we will also expect that a number of jurisdictions will look at introducing new incentives that fall under this new QTI regime. Now handing over to Frederick again for the last piece of this package, the real piece, the side-by-side package.
Thanks, Stephen. So clearly within the side-by-side package, the side-by-side system rules that are here are very important. Essentially what they are about is getting the US on board of a deal and having Pillar 2 rules in addition to rules by other countries like the US, while the Pillar 2 system can remain intact, provided there is not a risk of tax avoidance. And what these rules are about essentially is making sure the DMTTs can continue to be levied by the jurisdictions where a group is based outside the UPE jurisdiction, while at the same time having a good interplay between jurisdictions like the US, which both have an appropriate domestic tax regime and a sufficient worldwide tax regime to make sure that profits are taxed globally at a minimum of 15%. So very shortly, there's a side-by-side safe harbor which says if a jurisdiction has a qualifying domestic tax regime and a qualifying worldwide regime, the UTPR and IIR is switched off for that group. While if we have a jurisdiction that only has a qualifying domestic tax regime, so it taxes its own profits appropriately, the UTPR will be switched off for the UPE jurisdiction. Dustin, I would be very interested to hear from you what the impact is of this for the US clients, US companies that suddenly, have US rules on the one hand and DMTTs on the other hand. What is their responses and what do you expect the US government to respond to those rules?
Yeah, I think, if the description of the two-pronged test sounds like it's describing the US tax regime, it absolutely is. Although it was written as a general safe harbor, it was clearly written with the US in mind and to fit the US. Unlike, I think, the the safe harbor for tax incentives, which benefits the U.S. and the U.S. R&D credit, but is available to other countries. I think there's a very short window for other countries to apply for this one. It really is aimed at the U.S. I think moving forward for U.S. headquartered multinationals, it will essentially mean not only escape from the IIR and the UTPR throughout the entire group moving forward. It will be relief from many of the reporting obligations moving forward. You can essentially firewall off everything and only have to worry about calculating the QDMTT in the jurisdictions in which your subsidiaries are active in. A couple caveats to that point potentially is number one, this is proposed to be effective from 2026 moving forward. So for the 24 and 25 tax years, I think U.S. multinationals will have to rely on the existing safe harbors and will have to do all the compliance requirements that will be in place in order to take advantage of those safe harbors which are in place. Christina and Ross also talked a little bit about implementation of this for financial statement purposes. I think until implementation actually occurs, even though it's expected, for Q1 financial statements, it'll be a question of whether folks can rely on that if it hasn't actually been implemented, if these safe harbors haven't actually been implemented in the jurisdictions in which U.S. multinationals are active in. I think maybe the final point I'll make here is that clearly the U.S. argument for the safe harbor was, hey, we don't need the same rules as everybody else because our rules are already robust enough to achieve the same result. But I can tell you from talking to folks internally at the U.S. firm at BDO and to some of our clients, there is already some eager and aggressive discussions going on about ways that there may be, now that there's a carve-out, for the U.S. to continue to tax plan under our current regime, and if there are opportunities that maybe U.S. multinationals don't have, that maybe other multinational headquarters, other jurisdictions that will be subject to the full extent of the rules won't have, to base a road out of high tax jurisdictions and go to lower tax jurisdictions. Obviously, of course, you have to work with all the restrictions in the U.S. tax base, but those are different in some important ways to the way Pillar 2 is going to work for everyone else.
Thank you, Dustin. Very insightful to hear the US perspective as well. We are already a bit in extra time, so we'll try to wrap it up quickly. Basically, what are the key takeaways? The future of Pillar 2 is now secure. That's also clearly the communication from the OECD. So a wait-and-see approach is no longer really an option. This is really going to be in place and will be monitored and enforced. Obviously, the OECD will come with additional guidance later on specific elements, and also they have committed on further working on additional simplifications. If we look at the simplification, as Frederick and Ross mentioned, the simplification here is a bit of a relative term. It does require a bit more work, or quite a bit of more work, than we are now currently used under the CBCR safe harbor. And therefore, companies will need to make a validation on what type of safe harbor can they apply. Will they try to stick to the safe harbors that are currently in place, switch to this new simplified safe harbor ETR calculation, or basically apply the full globe where necessary. And that will also drive the need for a further investment in technology or not, depending on the complexities in the group and also depending on the number of jurisdictions that do qualify for this new safe harbor. And as also Frederick mentioned, the new simplified ETR is done on a jurisdiction by jurisdiction basis, so it does not look at the global consolidated accounts. So it's an assessment that can be made on a jurisdiction by jurisdiction basis. And basically from there you can determine what's basically your preferred compliance effort and what type of technology investment do you need to make. This basically wraps up our webinar, 5 minutes in extra time. Really like to thank my co-presenters from around the globe. Hope this was really insightful for you. If there's any questions, we will be sending the slides and the text alert that was prepared earlier to all the participants. And then you can also look back and or basically address us with specific questions you may have. Thank you for your attention and speak to you later. Bye-bye.